Gold has been reaching record highs, and the same question is being asked everywhere. After such a strong and sustained rise, is gold setting up for a major crash, or is this rally fundamentally different from the past? In this video, the goal is not to generate excitement or fear. The goal is to understand what is actually driving the price of gold and whether history truly supports the idea that gold must collapse after reaching new highs. To answer that question properly, gold must be analyzed as what it really is. Gold is not a stock. Gold is not a speculative technology asset. Gold is a monetary asset. Its price is a reflection of confidence or lack of confidence in paper currency, monetary policy, and long-term fiscal stability. Once that framework is understood, the current environment looks very different from what many headlines suggest. Where gold stands today. Over the past year, gold has delivered exceptional performance. It has not only risen sharply in nominal terms, but it has also significantly outperformed major equity benchmarks. While stock markets have produced solid gains, gold has risen far more aggressively. That relative outperformance is important because it signals that investors are not simply chasing returns. Capital is intentionally moving into gold. When looking at short-term charts, the rise in gold appears steady and controlled. The move does not look chaotic or driven by panic. It looks deliberate. However, when long-term charts are examined, covering multiple decades, the rise can appear dramatic. This is where discomfort often begins. Many investors see a steep upward curve and assume that a collapse must follow. That assumption, however, is based on a misunderstanding of how and why gold moves. A common but dangerous misunderstanding. One of the most persistent misconceptions in financial markets is the belief that gold falls simply because it becomes too expensive. Gold does not fall because it reaches a high price. Gold collapses when its role as monetary insurance is no longer necessary. This distinction is critical. Gold is valued based on trust, credibility, and purchasing power. To understand whether gold is vulnerable today, it is necessary to examine the periods when gold truly collapsed and identify what actually caused those declines. The 1980 gold crash explained correctly. The most frequently cited example of a gold crash occurred in 1980. Many people point to this period as proof that gold always crashes after a major rally. However, that interpretation ignores the actual causes behind the decline. During the 1970s, inflation in the United States was severe. Oil shocks, geopolitical instability, and monetary mismanagement eroded confidence in the United States dollar. Inflation expectations became deeply embedded in the economy. Gold reflected this loss of confidence. It rose steadily throughout the decade and accelerated sharply toward the end of the decade. By early 1980, the problem facing the economy was not inflation alone. The deeper issue was credibility. Financial markets no longer believed that policymakers were willing or able to stop inflation. That changed abruptly under Federal Reserve Chairman Paul Volcker. Instead of gradual policy adjustments, the Federal Reserve implemented aggressive and painful measures. Interest rates were pushed to extremely high levels, reaching the high teens. This was not symbolic tightening. This was a direct and forceful attempt to restore confidence in the currency. Why gold fell after 1980? Gold did not fall in 1980 simply because interest rates increased. Gold fell because real interest rates turned sharply positive. For the first time in years, holding cash and short-term government bonds provided a guaranteed real return after inflation. Savers were no longer punished for holding United States dollars. As a result, capital no longer needed to hide in hard assets simply to preserve purchasing power. At the same time, several reinforcing developments occurred. Inflation expectations collapsed. The United States dollar strengthened significantly. Global capital flowed back into dollar-denominated assets.
foreign investors regained confidence in United States monetary policy. This restoration of trust came at a high cost. The economy entered recession. Unemployment rose sharply. Borrowing costs became extremely high. Asset prices suffered. However, the Federal Reserve accepted this pain, and that willingness to endure hardship restored credibility. Once credibility returned, gold no longer needed to act as monetary insurance. Its role diminished, and its price declined accordingly. The true lesson of 1980. The lesson of 1980 is not that gold collapses after reaching new highs. The lesson is that gold collapses when policymakers prove, through sustained action rather than promises, that holding currency will preserve purchasing power better than holding gold. That is an extraordinarily high bar. The 2011 peak and slow decline. Another period often cited as evidence that gold always collapses is 2011. Following the global financial crisis, central banks around the world implemented unprecedented monetary stimulus. Balance sheets expanded rapidly. Quantitative easing became a dominant policy tool. Investors feared currency debasement, inflation, and systemic instability. Gold surged as insurance against these risks. However, inflation did not materialize in the way markets expected. Globalization, technological advances, weak wage growth, and excess capacity kept inflation subdued. As time passed, fear gradually faded. The Federal Reserve signaled an eventual normalization of policy. Real interest rates moved higher. Equity markets recovered. Gold did not crash suddenly. Instead, it entered a prolonged period of gradual decline. Once again, gold did not fall because it was too expensive. Gold fell because its insurance function was no longer required.
The pattern behind every major gold decline. Across history, meaningful gold declines occur when three conditions align simultaneously. First, real interest rates turn positive and remain positive for an extended period. Second, the United States dollar enters a sustained strengthening cycle. Third, confidence in monetary and fiscal policy is restored. When these conditions are absent, gold corrections tend to be limited and temporary. This framework is essential for evaluating the current environment. Why today is fundamentally different. Many comparisons are made between today and past gold peaks. However, when the underlying conditions are examined carefully, those comparisons quickly break down. Real interest rates remain negative. Although nominal interest rates have increased, inflation remains persistent across many sectors of the economy, including housing, healthcare, insurance, and services. Purchasing power continues to erode. Cash does not reliably preserve value. Gold does not require runaway inflation to perform well. It only requires that holding currency fails to protect purchasing power. That condition still exists. Government debt levels have changed the rules. In 1980, United States government debt was relatively low compared to the size of the economy. Today, debt exceeds the size of the economy itself. This reality severely limits policy options. Extremely high interest rates would cause government interest expenses to rise to unsustainable levels. The aggressive policy approach used in the past is no longer practical or politically acceptable. Persistent fiscal deficits. Large and persistent government deficits continue to undermine long-term confidence in fiat currency. Markets are forward-looking. They price future risks, not just current conditions. Central banks are accumulating gold. One of the most important structural differences today is central bank behavior. Central banks are buying gold at record levels. They are diversifying reserves away from overexposure to the United States dollar.
This creates a baseline level of demand for gold that did not exist during previous peaks and fundamentally changes downside dynamics. The dollar faces long-term challenges. While the United States dollar remains dominant, long-term trends point toward gradual diversification in the global monetary system. Trade settlements and reserve allocations are slowly shifting. This weakens the long-term case for sustained dollar strength and supports gold's role as a neutral monetary asset. What would actually cause gold to decline meaningfully? Gold prices can fall. Corrections and volatility are normal. However, a true structural bear market would require several conditions to occur simultaneously and persist over time. These include sustained positive real yields, long-term fiscal discipline, a strengthening dollar, central banks reducing gold exposure, and political willingness to accept prolonged economic pain. At present, these conditions do not appear to be aligning. Realistic downside scenarios. Rather than asking whether gold will crash, a more realistic question is what type of downside risk exists. One possibility is consolidation, where gold trades sideways for an extended period. Another possibility is sharp corrections within a long-term bull market. Declines of 10 to 20% can occur without breaking the broader trend. The least likely scenario is a sustained bear market, which would require policy changes incompatible with today's debt levels and political realities. Final thoughts. Gold does not fall because it reaches new highs. Gold falls when confidence in fiat currency is restored through credible, sustained policy action that delivers real returns and fiscal discipline. When today's environment is compared to periods when gold truly collapsed, the differences are significant and meaningful. This does not mean that gold will rise in a straight line. It does mean that history must be understood correctly. Understanding why gold moves is far more important than reacting to headlines. Thank you for the support. Please subscribe, and I wish you a very nice day. Take care.